All right, all right. We are going to get started here in just a second. All right, all right. We are going to get started here in just a second. Before we do, I want to talk about a couple things with everybody. One of those things being, why are we doing this? Why am I having this webinar? And why am I going over all this? And why do I want to talk about this stuff? So I've been following a lot in the insurance industry, following along a lot with the insurance industry and the things that happen in my industry, obviously, because why I'm in the industry. So one of the things, and I'm going to unshare my screen here first, just so I can talk with you guys. One of the things I want to talk about is who we are and who we're not. So Square One Financial Group, LLC, we are an insurance agency, okay? Insurance agency, keyword insurance. And I think that there is a big hype online about insurance agencies. And one thing insurance agencies, and I bring this up for a lot of new and young insurance agents that are out there, is that we are not financial advisors. So one thing, I'm going to say this as a recommendation for all the younger agents out there. Stop telling people that you can replace their advisor. I've kind of heard that one. You can't, you don't have the same licensing or educational background. And there's legalities with that, right? The things I talk about today is everything that we can do as an insurance agency with an insurance license. And if there are things that sound interesting that you don't know about and you're an agent, you want to know more about it, great, reach out to us. But understand that everyone should have multiple buckets for their money, okay? Whether it be in real estate, whether it be with their advisor or their retirement plan. In fact, one of the things I wanted to bring up today was about something called a LIRP, or a life insurance retirement plan, okay? All that means is it's part of someone's overall retirement plan, and it's a part of it that's based in life insurance for what life insurance can do for that client or individual. What it's not, and what we need to start taking responsibility for, is we need to stop taking advantage of the people who don't have advisors and convincing them they don't need them, and start teaching them about how life insurance really works for the sake of life insurance. So that way they can get the additional help they still need, whether it be from an advisor, I don't care if it's a real estate broker, investor, whatever it is, because people in their entire financial household, they're going to have more than just life insurance, guys. So I don't care who introduced you to life insurance, but if they told you that it's the one and only way to get wealthy, stop listening. Like, that hurts my ears so bad. And we have to understand that there's a whole financial household that people have. And then when we start talking about life insurance and retirement planning and making $1 million babies, we have to talk about it from the viewpoint of an insurance agent or general agent or broker or agency, right? Or an individual life insurance sales agent. We do not have the right to step on the feet of a financial advisor, right? In fact, if you're smart, learn from them, work with them when it's appropriate. There are times when it can be appropriate, right? There are advanced strategies that you can do in life insurance, but you need a banker to work with. You can't do it alone. And in those instances, you're going to want to be friends with people that you can help get those big cases done for affluent clients that want to do special things that might not be available to other people due to cash flow, right? But they can do it. So you want to be able to help them? Well, you got to have some friends in the right places to be able to help them. You can't scare everybody off, because life insurance is not the end all be all, right? There are a few IRS codes that we can follow, 7702A and 7703B. That does allow money inside of life insurance products to grow tax free. Now, there's a little caveat there, guys, and I made some notes of things I didn't want to forget to say. So one of those is be careful with using the words tax-free, right? There's a little saying, last in, first out, okay? And basically what it's saying is the money, the little bit of money, the interest that grows inside of there is tax-free. But it doesn't mean the entire account is tax-free. So you have to make sure that you look at the numbers with your clients and explain to them what all that means. The $1 million baby plans, they are real, but don't just read the hype on the bullet points of what they provide. Make sure you get with an agent and you find out more about funding the $1 million baby plans, because if they are not funded properly, or what we call set up appropriately, they just won't work. You're going to have really expensive contractual paper that doesn't do what you want it to do for you or your child. The same goes for IULs on adults, right? They have to be set up properly or they're just not going to work, right? And there's different things like level versus increasing, whether you're overfunded or you're just paying, target premium. And you may not know what all that means, but guys, let me tell you, these things have to be discussed with clients in order for them to be set up appropriately, okay? So I think I covered all of my on top of the high horse stuff I wanted to get off the table, right? Because I do see a big resurgence of new agencies getting started, high levels of recruiting. That doesn't always mean high levels of training. So I just wanted to cover a couple bullet points out there for maybe some of the newer agents out there that may need to know some of that information, okay? So now I'm gonna share my screen again and get back into our actual presentation here, and get right into it. I promise I will not make it take too long, but it will be fun. I will crack as many jokes as I possibly can. And let's view our little slideshow here. So financial solutions from birth to burial. And so this is Square One Financial Group. And to give you a little bit of a background, I am going to cover everything from birth to burial. And what I mean from that is from whether you're born until you die, right? You have different plans. I'm even going to cover funeral plans, guys, because when you are planning for retirement or you have retirement, a lot of times retirement plans are based on making sure what you have enough money to last without working through retirement. And sometimes an unexpected funeral that can cause a blow to your family's finances, like a surviving spouse. And so even funeral plans are another bucket. So when I tell someone, hey, you don't need life insurance, you got a funeral plan. No. When I tell someone you don't need a funeral plan, you got life insurance. No. When I tell someone you don't need a retirement plan, you got life insurance. No. When I tell somebody you don't need a car, you got legs. No. Okay. So let's just get real about this stuff. Okay. Everything has a purpose. Okay. So I am Jason M. Woodard, Jason Michael Woodard. I am one of the co-founders of Square One Financial Group, LLC, here in Jacksonville, Florida, which I usually say beautiful Jacksonville, Florida, but it's raining today for no reason in the middle of the summer. So it'll probably be 45 degrees when I wake up tomorrow morning after it was 90 degrees today. If you live in Florida, you'll get that joke. We've had some exceptionally cold mornings, even though the winter time has passed. I don't know what's going on in Florida. It's been really weird. Now, what do we do? Services we offer, okay? We offer life insurance, cancer and critical injury protection, tax-free retirement planning, utilizing life insurance, right? There are other retirement planning strategies you may want to discuss with your advisor, right? Advanced market strategies, utilizing life insurance, and something called leverage planning. Is there a way to use other people's money? Well, you say, well, yeah, the wealthy people do it all the time. How do they do it? How do you leverage other people's money so that you can make money in order to become wealthy or just increase savings, right? Things you can do with a life insurance license, health insurance, long-term care, 401k rollovers. If you have an old employer, for example, and you could be paying fees on that plan for management, that money could be being affected by market ups and downs, where I always tell tell people that time of your life has passed, but that money has been built up once. Do you want to put it away safely, let it continue to grow, or do you want to roll it into something else that has more risk? I cannot tell someone how to feel about that, but I can give them options that are insurance based. Of course, at all times, they're obviously open to or allowed to use their common sense and speak with their advisor if they want to on other options as well. But again, I can tell you what options we can provide as an insurance agency. Now, who are we? Do we have your money is always the question. At Square One Financial Group, we never actually hold anyone's money. So a lot of people say that an insurance agent took my money. No, we actually are the middleman and the educators for all of these companies. So if you see this and you see a company on there and you know the little jingle, Nationwide is on your side, everybody knows it. We represent top A-rated carriers just like this every single day, listed on this screen. And we help you find the right carrier that has the right solution in this forest of names and logos that the only thing you know is I've heard these names my whole life. And pretty much there's a natural trust for a lot of these agencies out there. Because of who they are. Aetna, Blue Cross Blue Shield. I mean, these are big companies that have been around for hundreds of years. So that's who we work with. We're contracted to help bring their services to you, the client, with the proper paperwork, the proper education, and explanation of all their products and services. Now, what we want to do is talk a little bit about life's checkpoints. We said today is all about birth to burial, right? And it's in our DNA, number one, to do a lot about what we're told to do when it comes to money. So there's also different times in our life where we have to decide on different times to change our financial strategy. So these are kind of the top bullet points of times in your life where you may change your financial strategy, and talking to an insurance advisor may be important, right? So the birth of a child, obviously you've seen 529 plans were popular many years ago. You've seen what do you call it? The Florida Prepaid College, which has limitations on your choices. You've got weddings, you've got a kid's first car. My son's going to be 16 on September 13th, one of my children. You have planning and funding college. Do you want to do the college savings plan, or do you want to go an insurance-based college funding route that can have planned distributions ahead of time and different things like that during the years when your child won't be working, but they'll be in school, and you want them to have additional monies available to them tax-free. Those are kind of things that you can set up at birth. Right now, we don't stay babies forever. So the next thing you know, we move into home ownership, right? We meet the woman of our dreams, right? We have mortgage protection, right? That's a term product, right? Which is really a beginner product, but it's something that it's easy to run a quote and provide, but that does have a lot of nuances that people need to know about, whether it's increasing, decreasing. Is it a true mortgage protection policy, or are you just buying a term? Right? Because they can work differently, and they are actually different policies. There's a million different various insurances that I don't even sell, like property and casualty. In fact, I love partnering with property and casualty agencies that don't do life and retirement planning, because I can help them and they can help me. Because guess what? Throughout your life, you're going to have various insurances, and I need people that I can trust with my clients and our clients to refer to. Downsizing, right? We spend our whole life buying stuff to build up this life for our family. And one day our kids move out and we go, oh my gosh, I've got like 20, 30 years left on this earth and I don't need all this crap. I definitely don't need all the bills. What am I going to do with it? When you start downsizing, okay? When you do that, typically what happens? Well, you have a little extra cash, right? There's another phase in our life called accumulation, right? During that time, what's going on in your life? You have career growth, right? You're setting up life insurance through work. But then do you have a personal plan set up in case you ever leave that job, lose that job, get downsized, get fired? You know, is there something that you own that you can take anywhere you go? You're raising a family, you're starting to save. For the first time in your life, you're thinking about that home ownership and that asset. And you're thinking about, how can I protect that asset? My children are assets to me. How do I protect them? How do I protect their future finances, right? How do I protect my wife from if I'm not here, right? These are all things that we got to think about, right? Now, as we get a little bit older, guys, we see a transitional period. Kids are moving out slowly, right? We're having to access our savings for the first time to replace roofs. The house is a little beat up. We got taxable events. Say if we live long enough, let's say we've been ducking and dodging Uncle Sam for a while, right? If we've been doing that, we have taxable events that could be something like an RMD, like a required minimum distribution, where Uncle Sam says, "Hey, you know, you've been holding on to that chunk of change without paying tax on it for a long time now, and I think maybe it's time you pay." I'm not sure how much time you got left on this earth, so I think it's time for you to pay your taxes. Now, your decisions of what to do with those accounts directly impacts how much those taxes are. Okay. Now, moving and protecting life's savings, inheritances, making it all last. These are all things that come up in the transitional period of life as we grow from, you know, our 20s into our 40s, really. Like me in my mid 40s, I have, you know, I could come into money, say if someone close to me passed away, hypothetically, right? Anybody could do that. That happens in our transitional period. What am I going to do with it, right? I remember, and not all client stories are good, but I remember a client who had a lot of money. I advise them that due to their current lifestyle, that they may want to save and protect some of it. Now, they said, "No, I think I got this." And the last time I checked, you know, he's not with his girlfriend, and you know the money is gone. And he's going, "Man, I really wish I would have saved that money." Kind of like a lot of people say, "Man, I wish I would have got Bitcoin back in the day when they said it was going to be big and they just didn't." Well, this is a little more proven than Bitcoin. You know, insurance investments and things like that. And I apologize, we're not supposed to use the word investment, but insurance planning accounts, right? Insurance savings accounts. They are something that has been around and in force, and its job, right? We protect our house, our kids, our life, our home, our it's our house, our car. You know, you can insure anything. We insure our cell phone, even though the insurance isn't worth anything. You still got to end up buying a new phone. But at any rate, we insure everything during this phase of our life, and it's just important that we understand the ins and outs of it. Now, let's talk about distribution. Here's something that I've run into myself, and I want to slow down a little bit here so I don't get tongue-tied. When we're talking about distribution, we're talking about all kinds of different things, right? Whether it be Medicaid spend downs, whether it be going from aggressive to safe investments and when you should take your distributions, whether you're trying to do any and all of this stuff while avoiding tax consequences. Uh, if you're doing estate planning with life insurance as a tool, when are you going to retire? What is your tax-free income stream going to look like if you have one? Are you interested in learning how to have a tax-free income stream at life, right? These are all discussions that you want to have with your financial strategists, right? With your insurance advisor and anyone else that you do finances with, right? And then finally, your exit strategy, right? We're going to talk about your final wishes. Remember, everything that you do throughout your life, you do it to build up a life or a comfort for your family, so that hopefully there's a legacy that when you pass, you can leave to your family. Typically, in most cases, when I sit down and I help someone pre-plan a funeral or talk to them, it's something they want to do because they realize, especially if they're interested in traditional burial, that by going to a funeral home and then purchasing cemetery and all this stuff. In today's number, guys, this isn't $10,000 anymore. All that stuff is reaching heights of between $20,000 and $50,000, depending on whether you're getting a traditional burial and the services, and whether you choose a high-end or a modest funeral home to work with, okay? So if you're trying to leave, say, hey, I had a modest living. I managed to make it through everything. I paid everything off, and I even got a $250,000 I want to leave to my kids. Do you really want 50 of that to go to a funeral when you could have had a pre-planned funeral? So it's just a different bucket, right? There's no one size fits all. If we opened up a shoe store, not everybody, and all I sold was size 13s, could I help everybody that way? No. So there's different buckets. Again, I'm gonna keep repeating that. So what are some current events or other life changes we need to talk about? So number one, there's been some changes to how they view the designation of a healthcare surrogate. You still need a healthcare POA, which is found in a living will, which empowers others to make decisions regarding your healthcare when you are unable to make such decisions cognitively, meaning you don't really know what's going on. We actually do provide those living wills for free if anyone needs those. All they have to do is reach out to us, and we will gladly set an appointment time to go over it. And we even have people that can notarize it for you if you need that done. It is not required in all states. That's why I say if you need that done. Okay. There have been changes on taxation of Social Security and retirement funds, which is no fair, right? When it talks about inheritance and different things like that, if it's not done right, if you go back to work, right, and you make too much money, these are all things that can trigger tax rates up to 85%, right? You have a $22,000 income cap in retirement, right? So do you want to pay over half your money in taxes and be taxed up to 85% on the money you go back to work just to make ends meet? Quite frankly, in a society that I see a lot of 70-plus-year-olds, at Publix, a lot of them just stay busy, and amen to that. But some of them because they have to. And I think that really, I think it really sucks, just to pardon my language, watch my tongue, but they grew up in a time when they were all promised work for a company for 30 years and I'm gonna take care of you for life. And a lot of those people had that ripped out from underneath them without warning. I know there are some large companies, for fear of lawsuit, I won't name their names, but I watched roughly 8 years ago. I was in the industry still already, and I watched as they completely just got rid of retirement plans, healthcare packages, just because it was just too expensive. They just said, we don't want to do it anymore. We traded in the private pension for a 401k where we take all the risk. And a lot of you guys have heard that, but who took the risk before? The person who promised you a guaranteed income. No matter how their company performs, they have to provide you with that income guaranteed. Well, we traded up for 401k where we got to put half the money in it, and the money is at the risk in the stock market. I mean, who's winning here, right? And they get a tax deduction for the write-off for the money they match us. But hey, who am I to talk? Let's talk about the taxation of retirement distributions, right? Secure Act 2.0, the age 4 required minimum distributions has increased to 73, used to be, I believe, 72, but there are plans to raise it to 75, which is helpful. However, that doesn't help if the cost of living keeps and inflation keeps going at the rate it is. So there's some discussions on that you may want to look at your plan, your financial plan, and say, hey, is this all going to work out for me, right? Talking about the Secure Act, new rules on inherited IRAs, right? Before, if you inherited an IRA, you could stretch distributions and payments over a lifetime. After, you must withdraw the entire balance within 10 years of the account owner's death. Okay, so you can no longer take that money out over a lifetime. You have to take it out within 10 years of an account owner's death. So that's something that is a major change, especially if you inherit money and you're younger. That can impact you a lot. Now, the question is, what do you do with that money? What do you do with that money? Don't be scared because rules change. How are you educating yourself what to do with that money? Can you protect that money for the rest of your life, right? What about inherited money? Most heirs only have 60 days to roll over inherited money. to a new account. Day 61, it is constructively received is the word. Now I want to ask a question. I want to look over the camera. Do any of you know what constructively received means? Well, according to the IRS, it means it's earned income and you got to pay full taxes on it, okay? That's what constructively received means, okay? So there's a lot of talk about what the wealthy do and do this because the wealthy do it and all this stuff. So I wanted to have a little talk, and you're going to notice the timeline's older. The timeline's 98 to 2014, and that is on purpose because I know that I'm 40 something and I want to speak to an age group, my age, a little bit older, some younger, but for the majority my age and a little bit older, because we were highly impacted by these years. And I wanted to be able to kind of explain some of the things in a logical sense that insurance plans or LIRPs, life insurance retirement plans, can provide. Also, indexed products can provide, whether you're talking about annuities, because there's various types of annuities. There's a particular type of annuity called an indexed annuity, versus a fixed annuity, versus a CD, versus a checking, versus digging a hole in the ground or burying it under your mattress. So let's start, and I'm gonna use my mouse. I meant to increase the size of my cursor earlier. So I don't know if you can see it, but I'll name out the colors. So let's start with a bank. Now, one thing I wanna point out is a lot of people are quick to judge, slow to listen. And I hear that a lot. Now, the reason for that is because we are only a direct reflection of what we have learned from the people we love and respect the most in our life, starting with our parents, aunts and uncles, and it layers out through our friendships and connections throughout our life. So if you had an uncle who said, I don't trust the bank, chances are you bury your money where? In the backyard or under your mattress or on your Cash App card because you don't think that's a bank for some reason. If you had an uncle who said, I did everything Warren Buffett does, chances are the only thing you're going to believe in is investing in the stock market, and you might be highly curious about what? The Bitcoins and digital currency that's out there right now, right? Because it feels a lot the same. Maybe you day trade. Maybe you have an app where you day trade on. I've got one, right? I'm addicted to that kind of stuff too. I love knowledge. I love learning. I like getting beat up, losing money and gaining money. It's exciting, right? But can I afford to do that with my retirement fund? You know, that's the question, right? Then you've got the blue line, which is something that is not new. However, it's often misrepresented, which is a lot of what I'll talk about in this video today, right? So let's start with a green line. Now, one thing you won't hear, and when I talk about misrepresentation, if you see this chart again, and I say, if you see this chart again from somebody else, what you probably won't hear them say is, you need all three of these. I'm just telling you the area I can help you with. Me over here, I can help you with the blue line. That's what my agency does. I'm not telling you the other ones are bad, but we are going to discuss how your money works because it is true. The stock market does have great returns looking back over 30 years, 33 years, whatever kind of look back you want to look at. Nobody can deny that if you're in the right investments. And again, that could be human error. Some people might blame my advisor, right? Not all advisors are as honest, just like all insurance people aren't as honest as you'd want them to be. There are advisors out there that'll call you up. Hey, Tim, you know, I know the market shook 50%, but don't worry, it bounced back 50%. And they want to try to make you feel good, rub your shoulders. Mainly they weren't paying attention to anything, and maybe they didn't, you know, plan ahead when there was good news or bad news coming. And to be quite frank, I don't know. I can't speak for advisors, but I know they're not all perfect human beings. I know they're not going to catch everything. I know in 2008 and in 2011, it wasn't easy to catch everything right. There were some warning signs, and you had just as many people arguing over whether or not it was true or not. So who knows? People make mistakes, right? People make mistakes, but at the end of the day, everybody needs everything on this screen. And I'll give you an example. If you get a massive inheritance, let's say you get $1 million, or you win the Florida lottery, which is an annuity, which is a life insurance product. But let's just say it's more likely that you'll get a $1 million inheritance than win $1 million in the Florida lottery. Now, if you get that $1 million, don't you think you should put a chunk of it in the bank? The green line, why? You know it's not going to get great returns. That's okay. But you have access to it without penalties, so that any other investments you make, you're not causing harm to those or to your finances, or I've watched people throw away 20% in penalties just so they can get access to money that they should have just had in a CD for a year instead of an annuity for 10 years because it was just too soon, right? I've seen people do single premiums that were too high when they could have did half of that, or they could have just done X amount of dollars from a savings account into a CD monthly over time until said time they felt more comfortable doing a larger contribution, because there are some annuities out there that you don't have to do one lump sum at a time, guys, right? But I've seen it. So I get that $1 million inheritance, let's just say. Living expenses got to come out of what? The bank. So a big chunk, let's say I put 250 in there. Now, I want to invest in the stock market, but I do know that there's some risk. Now, if I have $750,000 left, would it make sense to put it all in the stock market? Being the high return, high rates of return I can get, but also the high rates of risk? No, it wouldn't make sense to put all of it in there, but I may want to have a discuss with a licensed financial professional on how much, based on my suitability, my risk reward ratio or risk tolerance, I can put in there. And the rest of it, I'm going to do what the wealthy do. Put it somewhere where my money's protected, but it can still grow. Maybe I can put it somewhere where it's protected, it can still grow, but it can become an asset that I can leverage to make another investment that earns me more money than I take on a loan against that asset. And now I've got an arbitrage. What does that mean? It means I'm leveraging a loan and making money, more money than I owe on the loan every month in interest. It's like free money. But these are all things you can learn about, and they're things you can do with insurance products, right? But you got to learn about it. So let's talk about the graph a little bit. In 1998, if you were to put your money into a bank and you just let it sit there, you'll see what? You're going to get the lowest rate of return. It's really safe. It didn't move up. It didn't move down. It's just the boring green line, okay? Safe, extremely low rate of return. In fact, I will crack a little bit of a joke here. Why is it that the bank makes so much money? And if anybody sees this, you can chime in on it, and you can, on our YouTube channel, leave comments. But why does the bank make so much money when they give you so much little? Well, they give you so little because what? They're taking your money and they're putting it somewhere over here, which we'll talk about later. And they're giving you an agreed upon amount of money, which is just enough to kind of keep it in the account. It's something, right? But I thought at the end of the day, there's arguments. Could I cut out the middleman? Could I cut out the bank and put my money where they put it? That's one of those arguments that are out there. I would suggest talking with a financial professional. Now, we still need banks. Why? Everyday living, okay? Now, the red line is my stock market. So from 1998 to 2001, we had what? The tech boom in this country. If you were to put your money in any of the tech companies, you did very, very well, right? And then something else happened, 9/11, 2001. And then due to a very tragic thing that happened in our country, we see what? The decline of all of the stock market by a huge margin. Now, we got beat up a little bit. We regained our bearings. Around this time, we said, America got real popular, that thing, that little, America, right? And then our economy bounced back. 2009 through 2011, started in 2008, what did we deal with? 2007, we started getting a lot of warnings about these things called ninja loans. No income, no job, no asset. There was what was that movie? There was a great movie out there, The Big Short. And they talk about the housing crisis in America. And you see what happened with our accounts there. And from there on, you've seen a steady flow of what the stock market does till we get to today. Now, when we talk about the blue line and we talk about what the wealthy do, think about this. J.C. Penney's or J.C. Penney. That's an argument that's out there, and I'm not sure who wins, J.C. Penney's or J.C. Penney. There's an argument on the name. Anyway, I'll let you guys tell me in your comments. But he was able to pay payroll, and the existence of that company only exists because a life insurance plan that built cash value held it in a safe and protected, guaranteed manner was available for him to take a loan against as an asset so that he could pay his payroll. Much better, I can keep talking. Now, had that money been at risk in the market during, let's say, the housing crisis, would all the money had been available for J.C. Penney to borrow in a loan format to pay his payroll? Another interesting fact about life insurance, the money he loaned, right? You guys hear a lot of things like be your own banker out there. There's also something even cooler called reverse banking, right? Really cool stuff out there you can get into if your insurance advisor knows it and if they have the right connections, because some of it, like I said, require working with a physical, actual real bank, like a Chase Bank, in order to pull some of this stuff off, right? You're not going to find it in your average life insurance playbook, right? But the whole concept of being your own banker, I'm not even going to get into reverse banking. That's something that you have to schedule an appointment with me. I'm just going to be honest. If you want to talk about being your own banker, though, it's really simple. If I take a loan out of my life insurance policy, I'm holding the note, but I also earn the interest. The money on paper is still what? In the life insurance policy, gaining the interest the life insurance policy is gaining while I'm out spending it on something. Okay? I can pay it back, but I earned all the interest versus borrowing it from a bank and paying them back all of the interest from that loan. Okay. So what else is the blue line? What else does insurance provide? Okay. You'll notice, no, okay. Sounds too good to be true. Not everything's free. I get it. So let's talk about that real quick. Is there a cost? Yes and no, right? Well, there's a guarantee in specific life insurance plans where you could have a zero floor on tax deferred or even tax-free growth money, depending on products and stipulations. Now, in order for that to happen, you to get the zero floor, they have to make money somehow. I mean, nobody's going to make a business deal with you and shake your hand where they're 100% on the losing end of this deal. So what they'll say, well, we're going to give you all of the market gains up to a certain cap. And they may even give you a deal and say, hey, we'll even give you an added bonus of a participation rate of 120%, on some annuities, 200%. There's some crazy participation rates, which means whatever you make up to the cap, say it has an 8% cap, 6% cap, we'll do 200% as your participation rate, meaning if it's 6% cap, they're going to give you 12% crediting. Okay. So there's different things like that is available if you learn it on the growth side. But the reason the cap exists is because they're promising you a zero floor. So let's review that. In the red years when the market lost money, here you would stay level, okay? And actually, I need to readjust my page here. I don't like this. I need to edit this. This blue line should be straight across. I apologize. I get excited easy. The blue line would go up. What that means is point to point annually, it would reset when the market dips. So as the market tanks, the red line drops. You have a straight line from this point to this point until what? Until the market started rebounding again. Okay. Now, when the market starts rebounding again, it's going to rebound what? A little bit more aggressively than your insurance product because of what? Your caps. However, the timed value of money, if you know anything about that, you'll know that when you lose money, right? Not every year the market is up and not every year the market is down. We can't time it. Nobody can. So because of that, the formulas kind of work out. If you lose 10%, in the market, you got to make like 15% to break even. If you lose 100%, you got to make 150% back to make even. I don't have the exact numbers in front of me, but with that amount of growth, you have to have to bounce back to break even from your losses to continue your growth from there versus an insurance product where you can be safe from point to point. And again, the stock market has its purpose. We need all three of these. I'm just talking, how does insurance work? In order to get that, you have to be an insurance product. And in the long run, you're going to outpace the market in the right types of investments and or savings plans with insurance. Now, one thing you can look at is certain amounts. You can't say all, but certain amounts of this money, right? It would be irresponsible to say all. It's a case by case thing. So I got to be real. But certain amounts of this money don't even have to be taxed. Whereas in your 401k or your, regular qualified retirement plan, you haven't paid tax on this because it's been deferred until when? Until they say you got to pay taxes on it, right? If you take money out, you pay taxes on it, right? If you leave it in there until, the age where they say you can't leave it in there anymore, you're going to have to pay taxes on it, right? Now, the reason this is so valuable is I'll talk to you about the seed and the harvest, okay? If you had to pay taxes on one seed versus taxes on all the crop that grew, what would you rather pay tax on? The seed or the harvest? That's the advantage of life insurance. With my tax deferral in my retirement plan in the stock market, at some point, I'm going to have to pay tax on all that money they did not take out of my paycheck today. It doesn't make it bad. I mean, you guys get free money from some of your employers. Take that stuff, match it, right? But what are you doing with other monies and how is it being treated? Okay. That's what's important. So let's review that a little bit. Tax now, tax later, and tax advantaged, right? I saw a post the other day where somebody said you can do the same thing with a Roth IRA. Yes, you can. But there are some things that you can do with insurance that you can't do with a Roth IRA. So there are some differences, and it is not the client's responsibility, although it is, to find someone who knows what they're talking about, but it is the client, it is the agent or agency's responsibility to make sure the client actually understands what's going on and the difference before they make their purchase, okay? So let's start with tax now. What types of products are taxed now? We have a savings account. We have a certificate of deposit, right? Tax now, right? The pro is they're liquid, right? The con is they can grow interest that can be taxed later, right? So the taxable strategy is there what? Set aside a portion of your after-tax income into a savings account or CD. Taxes are paid annually on any earnings, right? An example of this type of savings is a certificate of deposit. So when you file your taxes, not in retirement. I want to make sure I clarify that in case I trip up. There's a lot of information, so sometimes I may say something wrong. So if I notice it, I want to make sure I said that right. Those earnings, right? You get your form in the mail every year, and you got to pay taxes, tax now on those earnings. Now we have tax later. That's our 401k, which could be an IRA, which is traditionally like probably a white collar or an institutional job. They give you a 401k. Publix would still give you a 401k, a big company like that. A 403b, if you are a teacher, right? Maybe a TSP if you're in the military, right? Annuities, IRAs, all things that could be what? Tax deferred, meaning tax later. Meaning the tax deferral strategy is what? Set aside a portion of your pre-tax and post-tax income into an annuity or pre-tax income for like a 401k, 403b traditional IRA so that the earnings can grow tax deferred. The taxes are going to be paid later when you distribute retirement income. Now, what part of those taxes, like I talked about earlier, last in, first out, all these other things, when you're talking about life insurance, when you're talking about these, what part's vested, what part are you actively employed, are you retiring? When are you taking that distribution? I mean, there's so many questions that come up in client conversations that, one is funny is even when you're still working for a company, disbursements from retirement accounts can sometimes be impossible because they're say either you're not fully vested and or they have a thing that says, hey, you actually still work here. And as long as you work here, you can't touch that money. So again, every situation is different. You could kind of spill too much on that one just because of the complications of it. So you really want to sit down and go over an individual case on that. Now, we have what we call tax advantaged, which are Roth IRAs, life insurance, municipal bonds, right? The pro is that they're tax advantaged. The con is that we can't write them off like we can some of our other products that are taxed later, right? So what is our tax advantage strategy? It's similar to the tax deferred strategy. You're setting aside a portion of your after-tax income into a Roth IRA, or a permanent life insurance policy, right? And then retirement income can be taken tax-free, typically through policy loans. My lips are sticking together. Let me have a sip of my coffee. So I say that again, typically through policy loans is it tax-free. It's important to say that, meaning could I go in and just request money from one of those accounts and get taxed on it? Yes, you could. So you have to make sure you're doing it right. There's what they call loopholes for a reason, because you got to know about them and you got to know which ones to jump through if you design it and you want it to work out properly. It does not make it wrong. You just have to know how to do it. Okay. Now, what are the perks with life insurance retirement plans? So you'll notice in the plan over here, you'll see LIRP, life insurance retirement plan, right? You'll see the perks. There's a lot of perks with using life insurance strategies for planning. And you'll notice I make a lot of pauses and say my words very careful. And that is because there's just a lot of regulation in our industry, and I want to make sure that I don't misrepresent anything. If I ever did, I would apologize and correct myself. But what are those perks? PERCS? Well, protection. We can protect your money. Can make sure that all your hard-earned money at some point, like a transitional period in your life, is in a product where it can be protected while it's growing, right? If you have an emergency, can you get emergency access? Yeah, you can get emergency access through policy loans, and or other distributions, although I don't usually recommend those because typically there could be penalties. But even in some annuities, guys, there's declining access fees where during the term of the annuity, say at year 5, you might only be paying 3% to get that money out, right? Say if you need to plan for retire, this could be a great tool, especially when you're talking tax-free distributions in retirement. Saving for college with a younger child. I have spoken about this many times over the last month, I think a lot in April, on our Facebook page for our business. And then I always cross promote in a few of our groups that we have for education for the general population and for other agents out there that just want to learn stuff they don't know. I want to connect with you and just teach it. Why not? I mean, come learn it. Let's do it the right way by our clients, right? But you can do college savings plans, again, that have to be set up properly. That is the big word, properly, where you can actually, I remember setting up one for my oldest son, where at certain years in his education, a check will just show up tax-free for that check, for that year income wise, to pay for his expenses during those years, like dorm room living or something, right? And then savings. Is it a great savings vehicle? Yes, it is. Any savings vehicle where you can have some sort of guarantees or protections is going to be a great vehicle. So let's talk about our money. Now, if I had $100, right, I could say a million, but that gets confusing. We talked about buckets and having multiple buckets. So we're going to talk about a 2-bucket presentation right here today, on the concept of if you were spending approximately, $600 a month, right? What would that look like if I had a life insurance plan and let's just say I'm, 25 to 40 and I'm spending roughly $600 a month in this plan. 200 of that dollars would be going where in one bucket for the cost of insurance to legally have the right to have access to the benefits and the tax codes that I want to take advantage of so that I can put my other $400 in there to reap all the benefits that I can get in this plan. So let's talk about it. 80% of my money, so I've got $100, 80 of my dollars, okay, I might have adjusted for inflation and all kinds of stuff into my safe money bucket, where I can also access it too. I might use it as a policy loan, like I mentioned before, but I have access to the money. Okay. 15% of my $100, so to speak, might be in that bucket, right? Taking more risk, right? Being involved in different investments that I can make that may have higher risk. And I can't guarantee for any reason that I'm not going to possibly 100% lose money. Let's just put it that way. Or I can't guarantee that there's not going to be any fees. Let's just say that, because I know a lot of life agents guarantee everything I do is feeless. Everything I do guarantees, and that's not always true. Now you're going to have another bucket. 5% of it might be your indexes, where you're looking to get a great rate of return, but you don't want the losses. So you'll see that you have a zero floor. That might only be 5%. So when I'm talking about your total assets of 100%, right? You got 15% in the stock market, you got 5% in your indexy. Some of this money is being dumped into this bucket, like I said, and that's why I say you can't say there's no fees in it. I should have just said stock market. And over here I have safe money, right? Because I may have it in fixed products. I may have it in a fixed annuity. All those discussions can be discussed with your insurance advisor, but at the end of the day, you don't have 100% of your money in one spot. That's what I want to make clear. Now you see your indices, you have your 0% floor, your 9 to 12%, right? Now, what other benefits do I have? And let's just say, with life insurance, what other benefits do I have for my $200, right? I'm not just getting the benefit of the indice or the zero floor protection and the, hypothetical rate of return of 9 to 12%, although I have seen that multiple times. I am required to say hypothetical rate in this format for this purpose. But if I'm talking about life insurance's other benefits, okay, I get death benefits, right? I get a death benefit. If I pass away, when I do this type of planning, my family doesn't just get my death benefit. They also get what? All of this money. And they can also set it up with beneficiaries and set it up to have tax-free distributions. There's a lot of things that can be done here with this money. Okay. They also have living benefits that I get with my policy. So let's just say it's $500,000 death benefit. Some living benefits. I recently posted a picture on our Facebook page for Square One Financial Group about the death benefit and living benefits that talks about, let's say you have a heart attack, cancer, or a stroke. Okay. That death benefit is available to you while you're living or alive, and it's called a living benefit. Okay. Now you can't access that in most term policies, right? There are some, but most not. But either way, it is found in what? Life insurance. I can access my death benefit while I'm alive, utilize that money, and not affect my cash growth account that has my index strategy growing at 9 to 12% with no market losses. And that I'm saving for maybe another creative financial strategy. Okay, now, what are some other benefits? If I'm not 59 and a half, when I'm looking at this bucket, right? Rates ranging from 0% to 12% returns, right? If the market tanks like it did in 2008, I might not make anything. I won't lose anything either, but I might not make anything that year in this account. Let's be very clear. However, if your advisor did call you and said, Hank, the market tanked 50%, and your insurance advisor said, hey, but don't worry, you didn't lose $1. And you go, oh, okay, cool. Right? It's really that simple, right? Now, at age 59 and a half, when I'm looking at certain retirement products or savings vehicles, there's rules on how much money a year I can put in there. Well, there's also rules in life insurance on how much money you can put in there. But guess what? I can increase the size of the life insurance policy. All of a sudden, now I can put more money in there. There's so many ways that life insurance can be flexible to meet your needs as someone who's trying to find safe, accessible savings plans that can grow great interest without having a lot of risk in the market. Now, also with the 72 and a half R&Ds, when you're dealing with annuities and life insurance plans, that money, for lack of better words, I'll use the word recycled. Okay, I like to try to speak in ways that people are going to understand. That's why sometimes you'll hear me think a little bit as I speak. I want to speak in simple terms that everybody can understand. But that money gets recycled back into the plan. It gets taken out, taxes paid, buy the plan, put back into the plan, and we can get into the details of that. But you're not sitting there writing a check on your taxes every year, right? So there's some great incentives to life insurance, retirement planning, and using specific types of life insurance for this purpose and different types of annuities. Again, like I said before, if I didn't say it, the Florida lottery is an annuity. Why does that make sense? Because they can go weeks on weekend, no matter what the stock market does. And that money is always building up. It's never declining unless what they issue a distribution and one of two methods, a lump sum or what? An income for life, just like your annuity. Okay. So as we move on, that completes talking a little bit about insurance and money. But I said we were going to talk a little bit about multiple buckets. And earlier I talked about a bucket that needs to be handled, separate from your life insurance. And that's funeral pre-planning. And it's actually our favorite thing to do. Our second favorite thing to do is what we just talked about. And our third favorite thing to do, unfortunately, is something like a term or a final expense policy, because although they are very needed for society, they're more like run a quote, here you go, talk about a few situations, make sure they can affordability is in place. But it's not as creative as some of this other stuff that we get to do. Part of the creative muscle in funeral pre-planning is going through 3 simple steps and determining what you want, documenting it so your family knows it and can find it, and discussing it with them again so they can find it. I have a terrible story I'll share real quick, and then I'm going to go through the rest of this before I bid you all adieu for the evening by finishing up with our funeral pre-planning section. But I remember when I worked at a funeral home, this poor family came in and they said, Dad has thousands and thousands and thousands and thousands and thousands of dollars in an account somewhere. But what do you mean somewhere? Well, he was taking his Social Security money. He didn't need it. He was well set up. So he was just depositing it into some account for one day. But he never wrote down or left a note or told anybody about the account because he didn't think he was going to die. It was an accident. Oh, did you ever find the account? No. Do you know if your dad listed a beneficiary so they could find you? We don't know. Has anybody called you? No. That is what I call a nightmare scenario. So you can have annuities with beneficiaries listed. You can have life insurance plans with beneficiaries listed. That does not mean that they have all the details they need, which is why a funeral plan is so important. It's not just about the funding side, which we love to help with. It's about the documenting all of the important information your family's going to need when it comes time to plan your funeral. And your preferences being a big part of that. So what is step one? I just mentioned preferences. It's determining what you want. So how do you want to be remembered? Did you jump out of helicopters in the military? Did you love it? Did you play NFL football? Were you an entrepreneur? Were you a mom? Was there something that you want to be remembered and memorialized at your funeral? Who knows about that? Have you talked about it with anyone, and have you determined specifically what that is? Do you want burial or cremation? I will tell you that in certain cities and states, cremation's on the rise. We have a lot of traditionalists out there that want to do the same thing their ancestors did, and or for their faith or religious reasons, don't believe in cremation and they want to be buried. Have you looked into the current costs of burial or cremation to determine if you're going to stick with your original thought process? Okay. What are your preferences? What's your favorite color? Who do you want there? Who do you not want there? These are all preferences. Okay. These are things that you have to decide when it comes to planning your funeral. And the only way to guarantee you're going to get exactly what you want at your memorial service is if you pre-plan it. Okay. Step two, you have to document it. Now, one thing is, and the most important thing to me is that it saves your family time and worry by reviewing and recording your final wishes in advance. Okay. Now, it doesn't mean when you meet with a pre-plan specialist that you pay for your pre-plan all at once. That's the beauty of pre-planning. You can spread your payments out over time, 10 years if you need to, right? It is not impacted as far as approval based on age or health. Anybody can pre-plan, okay? Anybody can pre-plan, okay? If anybody needs a pre-planning guide, meaning you want to start filling it out, you want to start documenting this stuff, please reach out to us. We would love to get a guide in your hand so that you can start the planning process. We also have a link that should be coming soon. We should have it any day, where you can start asking questions about planning. And then if you're ready to fund it, you click on a link and you can speak with one of our advisors about your options for funding. I mean, there's a lot of great things that we can do to help you when it comes with funeral planning. Okay. Now, step three is to discuss. You want to explain your wishes to your family and friends. Okay. And the reason that's so important is if they hear it from you, there's an old saying, from the horse's mouth. If they hear it from you, they're going to take it seriously and honor your plans. Okay. When they hear it from someone else, they argue. What do I mean? Well, there's some people in this picture wearing glasses. I'm wearing glasses. There are some really cool sunglasses that I found online that if I was to purchase them, I would have to wear contacts to wear them because I'm blind as a bat. Now, I've thought about doing so at some point. I'm at an age in my life where I think about spending money much differently though. So I'm hopefully quick to acquire and slow to spend, right? That's usually the idea as we get older, we become more respectful of money, right? So maybe I will, maybe I won't. But my kids, I can tell you, remember me with my glasses. I have children that are 3 years old or under. They're constantly ripping my glasses off my face. My oldest son might remember me when I used to compete in CrossFit. A lot of the times I would wear contact lenses because of the sweating, and my glasses would fly off my face, and then I'd be blind in the middle of a competition trying to run to see where I'm going, right? And so he might say, my dad didn't always wear glasses. I don't know what my preference is and how I want to see them. And he might have an argument or a disagreement with my younger children over, whether or not I should wear glasses. I don't want to leave that kind of legacy or environment or argument up to my kids. I just want to explain my wishes that I've liked my nerdy dark frame black glasses. Anyone that's known me for over 25 years, I've worn them in various types. One that matched the pair, where the arms matched my motorcycle, but they've always been the same, black thick frame glasses. This is who I am. It's what I like. And I prefer to wear all black. That's something else if you don't know me. That's what I like. Those are my preferences. And my family will know that that's what I like, and they don't need to argue over it by me putting it in there. Because, if someone decides they want to bury me in a hot pink shirt, I'm going to be very upset. I don't like loud colors. I just don't. And that's my preference. And somebody might say, I love hot pink. And I'm going to say, great, my daughter would love hot pink. Let's make sure you have hot pink flowers, right? I've even seen someone purchase a hot pink casket with a hot pink vault, because everything needed to match, right? Keep copies of your plans and policies in a filing cabinet or an in-home safe. And then let your family know where you put them to find the documents. If you remember my discussion earlier about the family who could not find those Social Security savings payments, we want to make sure that you can find, or your family can find, what you intend to leave as a legacy, or if it's just simply a set of instructions. They need to find it. Even a living will, guys, needs to be in there. We talked earlier in this presentation about a living will and needing a healthcare surrogate listed if you want someone to take over, right? Where is that living will? It should be along with your final wishes, your final living will, along with your funeral pre-plan, along with your what? Investments and your insurance policies. That's a lot of buckets to fit in your safe. It's a good thing it's paperwork, right? Now, veterans benefits. Veterans, if you're out there and you watch this video, remember, I am doing this for some agents. I'm doing this for some clients. I'm doing it for anyone who needs to see it. So I will be sharing this to our YouTube channel just as general information for all the things that happens from birth to burial. If you served in our military, first off, thank you for your service. If you have a DD-214, you are going to need it to qualify for consideration at the Veterans Memorial Cemetery. Okay, if you do not have it, you will have a hard time, if any chance at all, claiming your veterans benefits. What will they provide you at the Veterans National Memorial Cemetery is they are going to provide you with a headstone. They'll even, if you're been married, if you died in service, there are certain times where you may or may not get a casket. For the most part, you do not get a casket. I want to make sure I mention that. You will get a headstone. You will get a vault or liner for the space. You will get the space itself, meaning you don't have to buy a cemetery plot. As long as you're buried at the Veterans Memorial Cemetery, you will probably not go to Virginia because it's so full. I hate to break that news to everybody. There is a waiting list to get into there. So a local national cemetery like in Jacksonville, we have a beautiful national cemetery here. They do 30-minute services. You can get placed there, but you do need to get with a funeral home to get the service set up, or your family has a lot of paperwork to do. Hence, again, why funeral pre-planning is so important. The one thing the VA will not provide you with is your funeral or cremation expenses. Even if all you need is $1,500 to $2,000 for expenses and flowers and stuff associated with your goodbye for cremation, and you want to get placed at the Veterans Memorial Cemetery or National Cemetery, you're still going to need that funding available. Now, let me see before I go on. Yep. Let's talk about that funding specifically in a couple things, okay? Now, the average funeral right now, and I'm going to say this, is $7,800, $8,500 on average nationwide. I want to break your heart if you live in Florida. We have a ton of national chains, so it's highly competitive. So another big reason you want to pre-plan is that there are different types of plans out there. So we have different plans available, such as add-ons you can purchase where you can lock in the cost on your headstone, your urns, your caskets. You can lock in your rates. We have the ability to lock those in for a guaranteed fee for a very small plan that you can put in place, very small plan for that. We also have the ability to pre-plan your funeral, but what I want to touch base on is that they're not all the same. So let's just say you say, ooh, national median, 8,500. I was thinking no more than 10, which means if I want to get one from these really national chains, some of these guys are charging 15, 18 to $22,000 for a funeral. How am I going to afford that if I can really only afford max the $10,000 funeral? Well, you want to put as much of that feeling, as much of that information, as much of that desire into what? Your funeral plan. And then you want to go ahead and plan your affordable $10,000 funeral. That way, if anything ever happens to you, you have the funeral you can afford. Now, here's the thing. Let's say you opt for a 10-year plan. There is two different methods you may go about this. And I will not say any specific names, and I can't say that planning at a funeral home is bad, but I can say that when you work with a financial company such as ours, we have access to all of those carriers that I showed you in the beginning, and we have access to some proprietary plans that aren't always available in the funeral home when you go to pre-plan. And so one of the things that people always ask me, they say, can I make payments on this? Yes, you can. How much is it going to cost me? Depends on where you go. Well, what do you mean? When you go, and I will say most national chain funeral homes, most, and you plan a funeral, you're going to have the option to pay in full or do a funeral plan. Now, when you do that, what you're doing is you're signing a contract with them stating that your funeral will never cost any more than that, whether I paid it in full or whether I made payments on it. What you're not looking at is that you do not get the earned interest credited to that policy. You only get the death benefit because that is the contract. Also, okay, that policy, on a positive note, is portable in most cases. You can take it other places, right? In some cases, not. You got to check. You got to make sure you didn't sign something, right, with said funeral home that makes sure it's locked in there, right? But in most cases, it can be portable. So that is a good thing. Now, the other thing I'll tell you, though, is over 10 years, let's address how much is it going to cost me. I mentioned you're not earning the interest inside of it. So if I don't have that benefit, how much am I paying? Well, let's say that you come up with a plan at a national chain, and that plan is $220 a month times 10 years, and it comes out to be $22,000. Now, due to cost of insurance, that plan is $220. Why? Because they're guaranteeing, they're locking it in, and they're gonna pay off your funeral at any time, meaning what? If you died 2 months later, they're gonna pay off that $10,000 funeral, even though, as long as you check the right health boxes, even though you only paid in a few payments. And you go, oh, that's fair. But if you read the small print, the devil's in the details. What if I lived the whole 10 years? I have now spent $22,000 for a $10,000 death benefit. So the question is there a better way? Is there a better way to do the pre-planning? Yes, there is. Like I said, there are financial service companies that have access to carriers that funeral homes don't typically have access to. And in those plans, they're run a lot different because those plans are designed specifically to fund, AKA or finance funeral plans for a consumer with their best financial interest at plan or at hand in consideration. So let's just look at the difference. Let's say I had the same funeral was $10,000 and I decided, hey, I'm going to make my payments on that plan for 10 years. And I accrued $22,000. In some cases, it could be more. But let's just say, apples to apples comparison, I've accrued $22,000. Now, in the previous statement, I could only afford a $10,000 funeral, but I wrote in my planner, in my planning guide, that I really wanted that $18,000 funeral. Your family can now take that plan to the funeral home and said, you know, we looked at mom's planning guide and we realized that to protect us, she took out $10,000 in funeral protection in a plan. She itemized her funeral. She got everything set up. But she really did it through a funeral home that was going to be a little bit less expensive. And in here, it states that there's $22,000. Now, does that mean that we could upgrade, whether it be a national chain or not, to your preferred provider and get the $18,000 funeral that she wanted in real life, that she really wanted, and remember her the way she wants? And they're going to say, not only that, but you're going to get a check for $5,000 back when we're done. Come into my office. Okay? Because all of the money is the family's. It doesn't go to the funeral home because, and I'm not, and I will be very careful here. I'll say local funeral homes, they don't have the same expenses national chains have. So there's reason these plans are set up a certain way because they have to fund their expenses. They're giant companies and there's nothing wrong with that. Okay? That's just business. But where you choose to do business can impact your money. So I'm saying nothing negative against these larger chain funeral homes. I'm just saying that due to their size and their cost of operation, the plans that they have to use require them to make a little bit more money. So you have options, okay? Now, before I say goodbye, I want to say thank you for attending. Oh, and I missed one edit, and I will fix it later. I said in my post, if anybody watches this and you want to make fun of me, I will still deliver great information. So you can make fun of my editing prowess, and I'll fix that a little bit later on. But I want to thank anyone who attended. We had some people who bopped in and bopped out throughout the seminar or webinar, if you call it. But I am going to go ahead and repost this to our YouTube page where it will be there. So if anybody wants to just look up Square One Financial Group LLC on YouTube, you can follow us, like us, share, comment, ask questions. Same thing with our Facebook groups. We have a funeral pre-planning group. We have one for licensed and unlicensed agents that just want to learn a little bit more about the industry or just want to chat. Or learn more about marketing and what we do. We have a page for that, or a group, if you call it. And then we have another group for webinars where we would normally have hosted this video today, but I did it on my page because I feel like through liking, sharing, and comments of all my